Namaste everyone. At the outset, I thank you, Vasai branch, for giving me this opportunity to speak before you. Friends, I have just glanced through the schedule for this 2 days workshop or 2 days seminar, and let me tell you, it has been very thoughtfully designed, covering all the important aspects. So it basically started with the concept of audit, auditor's responsibilities, and I think Madhukar Hiregange sir had taken this particular topic for you. So since we are now on the actual form clause by clause analysis, I don't want to spend much time on what does audit mean, or what is the responsibility of the auditor and all those things. But just to begin, before I begin with this particular topic of analysis of GSTR 9C, let me tell you one thing, is that GST as a law is still under the development phase, and there are lots of challenges, there are lots of issues, and whenever a particular issue crops up, or whenever particular provision comes for a discussion, there are various ways in which various people are looking at that particular provision, and it all depends upon the experience that they have got in their respective fields. And therefore it's not incorrect to say that whenever a particular provision is capable of giving a multiple interpretation, in a group discussion of 4, there can be not 4 but 5 views of a particular provision. And that's what many a times happened in various groups, including the institutes group where indirect tax committee people meet. There are people from south, west, east, complete harmony of the professionals, and the best part of it is that depending upon the practices prevalent in respective regions of the country, a particular provision is interpreted in a particular manner, and therefore to that extent there could be different views that you may come across when you come across any publication that might happen, that might come from a institute's background. We have with us a very wonderful publication today, that is this technical guide on the GST, for which, let me tell you, various professionals, a group of professionals have worked upon. And let me tell you, I have got some of the feedbacks. I have also gone through that particular publication myself, but I have also got some of the views from various departmental people, especially the officials from NASIN, and they have said that this particular publication is really excellent. The time limit within which they have come out with this particular publication is extremely extraordinary, and therefore let me first thank our institute for coming out of with such a timely publication in time. Another aspect is that yes, there are certain views, there are certain expression where the author may have come across a difficult situation in taking a particular position, because when this particular form was placed into public domain, somewhere in the first week of September, if I'm not wrong, at that point of time, various organizations started studying, because that was a time when if there was something wrong, which we come across, which is patently wrong, or which is not really realistic for a chartered accountant or a professional to comply with, or for an auditor to comply with, it was for us to point out those things to the government. So we had gone through these particular forms, and certain representations were also made by institute, by Bombay Chartered Accountant Society, by Chamber of Tax Consultants. So various organizations have already made certain representations, and in some cases, may it be GSTR 9, may it be GSTR 9C, the wordings, the instructions are not very clear, and as a result of that, what position are you really going to take? That is going to be a very challenging exercise. We hope that that particular explanation or the clarification relating to that, which have already been pointed out to the government officials, will come in time. But then nonetheless, as of now, we all know that 31st December is the due date for us to complete the audit. We are today on 4th of November. So practically 2 months period which is there with us for carrying out this particular exercise, and this is what makes it very extremely important for us to have such kind of a sessions where at least we would be able to know the areas where there could be a controversy, there could be the cases where the professions might be required to take its views. So with this, without wasting much of a time, let us go straight away to the provisions concerning GSTR 9C. Again, since the audit related chapter is already over, let me also tell you a little bit recapitulation of what probably you have been told earlier by Madhukar sir. is that what is the provision under the law? The provision under the law is that we have to carry out an audit of the books of accounts of the SSC, and we have to also certify the reconciliation statement which he is required to prepare under section 44(2). So please note, although the form is same, there are two different responsibilities which are casted upon the auditors. One is the audit of the GST books of accounts, and another is the reconciliation statement, for which for the first time the government has come out with a very wonderful form, a very in-depth form. Earlier also under the VAT regime, those who have done, they may be knowing that in the VAT forms also there was one last sheet where the reconciliation was required to be made. But that reconciliation was not in a specific format. It was basically left to the discretion of the auditor as to how he wants to give that reconciliation. But today we have this particular reconciliation statement in a specific form, and there are various things that in that reconciliation an auditor is required to certify, and therefore this reconciliation statement is more in the nature of a certification, whereas this does not absolve an auditor from his prime responsibility of auditing or conducting the books of accounts of the SSC. And therefore in GST, first and foremost, an auditor is playing a dual role. One, he is auditing the books of accounts of the SSC, and another is that he is certifying the GST reconciliation statement. Now when we are talking about the books of accounts, let me also clarify that this books of accounts does not mean our general purpose financial statements. The general purpose financial statements are the one which we prepare under a particular statute or depending upon the generally accepted accounting principles which have been regulated, which have been governed by various bodies like Institute of Chartered Accountants of India and others. This is basically what we call it as a general purpose financial statements. But what books of accounts we are going to audit under the GST law are not those books of accounts. Under the GST law, section 35 specifically speaks about certain books of accounts, and various ways section 30, that particular chapter relating to books of accounts, accounts and records, are telling you as to what are the various records that you are supposed to keep under the GST. What as an auditor you are supposed to do under the GST, you are supposed to audit those books of accounts and not the general purpose books of accounts which is there under the GST law. So that differentiation, that distinction, one needs to keep it in the mind. So when we are talking about those GST books of accounts, what do you mean by that? So generally you have to keep the record of all your sales registers, return outward registers, your inward registers, your import registers, your export registers, debit note, credit note, advance registers. So all these registers are basically the books of accounts. They are together called as the books of accounts under the GST. So what you are going to actually audit is not the P&L account or the balance sheet which is prepared under the law, but those books of accounts. And that is very essential for me to mention over here, is that if you really look at today, most of the clients do not know, are not aware that these are the books of accounts that they are supposed to maintain. And therefore, although their entire process of filing of the return is over, still if you ask them, can you give me a sales register, they will say ki our system does not give that kind of a record, or it does not give that kind of a record in a proper manner. So please, your starting point would be to ask the auditee as to, do you have a sales register, a purchase register in a specific format? Now the government has been very kind enough not to give you any format in which that sales register, purchase register, or all other export register are to be maintained. What they have done under the rules, they have only specified the contents which are required to be there on those particular books, and therefore you can devise your format in your own manner. But you have to make sure that those minimum contents which are provided under the law have been specifically incorporated under that particular statute. Why? Because when you are giving your opinion, your certification, which is covered in part B of this particular GSTR 9C, which we will come in some time, what it basically says is that you have to give a view as to whether the books of accounts have been properly maintained by that particular SSC or auditee or not. And that is where it is required for you to first insist upon the auditee that these books of accounts you please prepare if it is not prepared already. Only then I would be in a position to come into the as an auditor, and then only then my audit function as an auditor will start. So that is the fundamental thing which one needs to really know, that the GST books of accounts is something which have to be there under the law. Unless until they are there, your reconciliation or any audit exercise may not start. In fact, this GSTR 9C, if you really ask me what this GSTR 9C is all about, this GSTR 9C is nothing but the differences between your general purpose financial statements and your GST books of accounts. The GST books of accounts is something which will give you a turnover in a specific manner, whereas financial statements will give you a turnover in a different manner. What this GSTR 9C tries to do, it only tries to bridge a gap between the general purpose financial statements and the GST books of accounts. So therefore, when you are recognizing something as an income under the general purpose financial statements, that income recognition may not give rise to the turnover in that particular year under the GST books of accounts. At the same time, something which give rise to turnover in the GST books of accounts may not necessarily result into an income recognition or a revenue recognition in the books or the general purpose financial statements. As an auditor, we are expert in both. We know what this particular revenue recognition standards are, how to read the financial balance sheets or financial statements of a particular auditee. We also know what the GST law is all about, and that's the reason the responsibility has been casted only on certain professionals, including chartered accountants, who are supposed to entrusted with this particular function of the auditing the books of accounts of the entity. So please understand, if you look at from the government perspective, what the government is looking at us is that they want from us an assurance that whatever has been captured in the financial statements has been properly reflected in the GST books of accounts. And something which has not been reflected in the GST books of accounts, there is a specific explanation for that. So this is the philosophy with which, as an auditor, we are supposed to play a role of a GST auditor. Now again, another aspect, lots of things have been talked about as to whether we are supposed to do the 100% vouching, whether we are supposed to do the 100% verification. I will give you my view, because obviously when there are experts, there are going to be experts view, which could be more than one. But if you ask me, really speaking, what do you mean by true and correct, and what true and correct things I am supposed to certify? The audit of the books of accounts is something which you have to do as per the auditing standards prescribed in India. The auditing standards does not require you to do 100% verification. It requires you to give a reasonable assurance that the books of accounts maintained are in accordance with the GST books of accounts. That's what the principles of audit is all about. And that is going to be remain, according to me, also in the GST regime. What is required to be true and correct is that whenever you are certifying that particular reconciliation statement, and whenever you are going to point out the differences between the two, those differences, those explanations, to the best of your knowledge and belief, should be true and correct. And to that extent, if there are any reconciliation differences that are required to be reported in this particular reconciliation statement, then you need to verify as an auditor as to what you are reporting is correct, true and correct. So that is where the difference comes, as to whether as an auditor you need to do a true and fair analysis of the GST books of accounts, or as an auditor you need to make a true and correct reporting of GSTR 9C. This is where the fundamental difference lies, or this is where your role will come as an auditor when you are going to certify any statement which is going to be in GSTR 9C. So with this, now let us go to clause by clause. Obviously this was not a very hectic session for me, because I didn't have to prepare any PPT for it, because I was told specifically that the main interest is for me to go into the clause by clause details, and the best part of doing that would be to throw before you the bare form. So it saved me a lot of effort in preparing the PPT, but nonetheless it also enhanced me, it gave me an opportunity to increase my database knowledge as regards what these interpretations of these various columns or these various contents could be. So let us start with the reconciliation statement. We all are professionals, we all understand the legal language, so I am not going into very basics. So I don't want you to give a basic slide as to what is the summary, what is an overview, it is divided into 5 parts and all those things. We all have gone through, I am sure, with this particular reconciliation statement at least once or twice. So we know what are the broad categories, what are the broad parameters. So let us go one step further and try to go into or dig out what are the main ingredients where the problems could lie or where the issues could crop up. So part 1 gives you the basic details. The financial year we all understand. Now the only problem is that when we are talking about a financial year, as we understand, it always starts from 1st of April. But the GST is basically something which has been started from 1st of July. So it is from the midway that that particular GST has been started. So the first fundamental question comes as to, when I am reporting in this particular format, do I have to also take into cognizance the items which are covered into April to June or not? So probably while we analyze the form further, we will be getting this particular answer. So therefore, financial year today, so far as this particular form is, means what we understand as a financial year. So it will start from 1st of April 2017 and end on 31st of March 2018. Then the second is GSTN number. We all know what the GSTN number is all about. GSTN number makes a particular person a separate, distinct legal entity in the eyes of the law. So this form is required to be prepared GSTN wise. This form is not something which is for a company or an entity as a whole. If you have got one GSTN number, this particular form would be prepared for that GSTN number. If you have got multiple GSTN number, this multiple forms would be required to be prepared accordingly. Legal name is an auto-populated field which is generally linked to your registration details which are there on the GST server. So if you ask me, this is just a form. What we are going to face a challenge later on is when these forms will become electronic. So when these forms will become electronic, we need to know, because many things in this particular form are going to be auto-populated, or they will be formatted in such a manner that you, as a user, you won't have much control over it. It will come on its own. So there probably at that point of time we will come to know what are the hitches, what are the problems, because the formulas are given in this particular sheet, but whether a particular value would be a positive value or a negative value, on that there are no instructions which are very much clear in this particular form, and therefore at some cases various ifs and buts and propositions, various kinds of propositions have been floated. Even in the institute's technical guide, certain presumptions have been made in order to make this form workable, because some people felt that on all those things there is an error in this particular form, so they represented. What institute has said is that if we want to interpret that there is no error, then what should have been the values, whether it should be positive value or negative values, that particular view has been expressed accordingly into the GST technical guide. Then coming back to trade name, if any, that is also an auto-populated field. And are you liable to audit under any act? Please specify. So let me also tell you what is the purpose behind this particular question. Is that if you look at part B, because this is basically part A, which is a reconciliation statement, we have got part B where the actual certification or audit certification of an auditor is going to come. That part B is again divided into two parts. The first part is applicable to those people who are liable for any kind of an audit under any other law. What it means is that those people who have conducted an audit under any other law would already have audited their general purpose financial statements. So for them, probably a different set of audit forms are there. For those who have not audited their general purpose financial statements, for them a different sort of an audit form or some different sort of an audit form is there. So we will also try to see what are the difference between the two a little bit later. But to begin with, let me tell you the reason why this particular explanation is there is in order to enable you to make your role much more clearer. So just if I have to explain to you right now in two lines, a person who is carrying out a statutory audit of a particular entity, and if the same person also carries the GST audit of that particular entity, then there is a separate form. If a person is carrying out a statutory audit of an entity is one, and if a person who is carrying out his GST audit is a different one, then obviously there is a separate form. So therefore, accordingly, the forms have been designed. So you take a case where a particular entity is not liable for any audit under any other law. In that particular case, probably a person who would be required to carry the audit of books of accounts and the person who is going to carry the audit of the audit under GST would be the same. So for that particular entity, your first form would be applicable. I will come to it little bit later when we will come to the certification part B of that particular form. So going further, part 2 is the reconciliation of the turnover declared in the audited annual financial statements with the turnover declared in the annual return. So the instruction or that particular description is very clear that it's a reconciliation between audited annual financial statements, what we understand is a general purpose financial statements, with the turnover declared in annual return. Now all the way I was telling that this is a reconciliation between the GST books of accounts and your normal financial statements, whereas if you really look at this particular form, it is giving you not the difference between the GST books of accounts and the financial statement. It is basically trying you to compare the difference between the GST books of accounts and annual return, audited annual financial statements and audit return. So this is where the first problem comes, because if you really look at the manner in which this particular form further goes, if you look at the idea or the concept of this particular form, what it tries to do, it tries to first compare in the first paragraph 5. So maybe after we come at the last stage of this particular part 2, I will come on it again. But if you look at what it tries to do, it tries to first ask an auditor that you please give your explanation on what is given in the books of accounts and what is given in the general purpose financial statement. And then you dig out further, because once you come across this particular distinction, then from whatever is given in the books of accounts and whatever is given in the GST or annual return, that you again compare. So there are two types of reconciliation which are basically contained in this particular entire form. One, you first identify what is the difference between the GST books of accounts and annual purpose financial statement, the general purpose financial statement. You take a position on this, because that is something which probably may not have gone into your annual return at all. Okay, it may have gone also, we don't know, but first you identify that particular difference. Then you try to make a distinction between your books of accounts and under the GST and the annual return. If there are any differences, you report that. So like that, this particular form flows. Even under the ITC side, it is the same philosophy that they have tried to come out with while designing this particular form. So let us go to the individual contents, part 2, 5, reconciliation of the gross turnover. Now this statement, please note, has nothing to do whether it's an exempt supply, taxable supply, nil rated supply, GST supply. What it shows that it does not want you to go into a particular details, because all those details are the territory of GSTR 9, that is annual return. Whatever are the bifurcations which you are required to make, whether it's a taxable supply, whether it's an exempt supply, is something which you have to make under GSTR 9. This table, this entire table will not basically make any distinction whether it's a taxable or it is an exempt. What is the purpose of this particular table? This particular table only speaks that this is the turnover under the general purpose financial statement. You have to arrive at the turnover under the GST books of accounts, and whatever are the difference in between, some of them, those differences, common differences, we have already listed in that particular sheet, and those differences which we could not list, that you appropriately take under the other adjustment, that is under 5O, which is plus or minus. So that is how this particular form goes. So initially, if you look at form part 5 has nothing to do with your annual return. It has nothing to do with your whether it's an exempt or taxable. It's purely a reconciliation between your financial statements and your GST books of accounts. So with this, let us now read further 5A. So 5A is something which starts turnover, including exports, as per audited financial statements for the state, union territory, and they have said for multi-GST and units under the same PAN, the turnover shall be derived from the audited annual financial statements. Let me tell you, when for this particular form, the representations were made. We all have come across the detailed representation which was made by Institute, which was running into some 80 pages. Okay, and similar sort of a representation, I would not say similar, but some representation was also made from other institution. And in both the institution, what was the common factor? The common factor was that the starting point was the all over India turnover. The starting point was all over India turnover, and then it required that out of all over India turnover, suppose you are auditing the books of accounts or the GSTR 9C only for the purpose of Maharashtra, then for them all India turnover, you reduce the turnover belonging to other states and you arrive at the turnover belonging to Maharashtra from your financial statement. That was the recommendations or the format which was earlier recommended to them. But wisely so, the department said we don't want to get into what is the turnover belonging to other states and all those things. Your starting point should not be the all India turnover. Your starting point should be the turnover of the state for which you are carrying out an audit. So that is the limited point, and in fact that is a good thing for the professionals, that if there are separate auditors one for one state and another for another state, then the question comes whether it is responsibility of which auditor to certify, because there may be turnover belonging to other state, that figure is erroneous, and everybody is basically taking that particular figure. So would that mean that all these auditors would become responsible for that incorrect statement? That was the question. By not including such kind of an adjustment in this particular form GSTR 9C, probably that dispute has got away with. So therefore now, when it comes to auditor's responsibility, the auditor would be responsible only for that state for which he is doing that particular audit. If there is a turnover belonging to other state, then that particular auditor may not be responsible. So that is the first thing that I wanted to point out when you are certifying, because ultimately this is a statement, this is one of the content of that particular statement. Then the next question comes as to then how we are supposed to take this particular turnover as. Okay, because how do I come to know that this particular turnover is really belonging to my state or not? Do I have to have any specific checking for that this particular turnover belongs to this particular state? Let me tell you a general understanding. In general understanding, the turnover belonging to a particular state means a state from where the final sale happens. So suppose there are 3 states involved. Suppose the plant is in one state, warehouse is in another state, the distributor is in third state, and in that particular state ultimately the final consumption is happening. So suppose Maharashtra is a state where there is a plant. Suppose Gujarat is a state where there is a warehouse. Suppose Tamil Nadu or the Uttar Pradesh is a state where there is a actual stockist or that particular distribution channel is set up, and from there ultimately the sale is happening in the books of that particular entity. So if you ask me, the logical thing is that the sale in the books of accounts is that particular place where the sale is happening last. Okay, so if I take that view, then basically speaking, all the intermediate transactions would not form part of a turnover in my books of accounts. So that is ultimate. Whether the general purpose financial statements requires me necessarily to do so, answer is no. So even while deciding which state you should give your turnover as, there is no legal principle or there is no guiding factor. So therefore, if you really ask me, it is for the auditee to decide under which state he is supposed to show or assign his turnover under the GST as income. It is up to him. What you need to only ensure is that when he is saying that after assigning this particular turnover to 10 different states, this is my position, that final position should match with his financial books. And that is something which you need to probably get an assurance by way of a representation letter from the client, that when you are declaring X as the income belonging to this particular state, you are also giving a representation that in respect of other turnover or other income, I have assigned it to at least some GSTN number. Or if you have not assigned it to some GSTN number, you have mentioned that this is a turnover or income belonging to an unregistered unit. So there could be some foreign branch which is outside, and the entire sale is happening outside. So probably the GST has no implication over there, but that income is still there in my books. You ensure that that particular income is belonging to something which is not registered under the GST for the purpose of India. So ultimately the completeness of that particular turnover is something which as an auditor one needs to ensure that that particular turnover is ultimately matches. In between that, what constitutes a turnover pertaining to your state or not, that is not something an auditor's responsibility is of. That is for the entities to say that this is the starting point, now you do your books of accounts or you do your reconciliation accordingly. So therefore, one distinction as to what should be the turnover, and let me tell you, these things go very bad when you come to, because many a times there are special exemptions that the entities involved or enjoy under the Income Tax Act. Some ATIB exemptions, some research related exemptions. So there the actual sale happens somewhere else. But for the purpose of those exemptions, they show that that particular sale is an income belonging to the one particular state. They prepare a separate P&L for that for the purpose of claiming that exemption. So there, ultimately it is for that particular entity to take a call where that particular income pertains. It's not for you. You just have to make sure that when they are saying that this particular income pertains to your state, Then for the rest of the states, the company has got a bifurcation, and the final total tallies with that particular income which has been reported in their consolidated profit and loss account. So this is the starting point as to what should be the turnover and how that particular entity is supposed to do, and what is the auditor's responsibility in that. The second thing is that the turnover word is itself a subjective word, because what constitutes turnover is not really defined. Obviously, under the GST law it is defined, but please note, what we are trying to see here is not the turnover under the GST. Here we are trying to see the turnover which has been given in the general purpose financial statements. So the question might come as to, should I take only the main sale item, because my main sale income, or I should also consider some incidental income like investment income or income from sale of any asset, whether I should also take all those things into as a part of a turnover. So if you ask me, the purpose of this particular reconciliation is to enable the department to identify that the things have been properly incorporated in this particular form. So therefore, at least the view that we are taking is, when the turnover is not defined anywhere under the law, the starting point is basically the main business activity for that particular SSE. So if a particular person is in the business of selling the goods, whatever is his sales income by selling of that particular goods, that you treat it as his turnover. Or if he is doing both sale of goods as sale of service, whatever is the income pertaining to sale of goods or sale of services that is shown in the profit and loss account, that you take as an income. All other items which are coming into the P&L account, that is something which is not, even if you don't take it over here, that would be perfectly fine, because it is not as if they are going to be ignored. They will be obviously considered somewhere in your residual adjustment. But from the simplistic point of view, so you consider when ultimately this data goes to the departmental officer, the departmental officer will try to compare this with the general purpose financial statements. Obviously, he will not get any clue, because the general purpose financial statements are consolidated, and this particular statement is only state specific. So then he will ask the bifurcation, give me the state-wise bifurcation. The auditee, the SSE will give the same bifurcation to assessing officer, which bifurcation they have given to you by way of a representation. There, that particular turnover would be the one which they are supposed to tally with the financial statements, and therefore whatever is clearly visible in my financial statement, that I should basically start with. All other items I should consider it as a part of the adjustment. So that is another aspect probably we should keep it in mind while declaring or while accepting any disclosure in this particular turnover 5A. But let me tell you, there is no legal point, there is no law, it's purely an reconciliation exercise. So whatever position you may want to take, you can take while disclosing this turnover as. So somebody wants to take the entire turnover, you can take it over there, but you need to make your subsequent adjustments accordingly. The second is the unbilled revenue at the beginning of the financial year. So if we look at over here, at certain places we have got additions and at certain places we have got deletions. So let me first tell you arithmetically how this formula works. So something which is added in the from the general purpose financial statements, what it means that in the financial statements you have shown less turnover, but for GST purpose that turnover should be more because of this particular item. So you add that particular item. Once you add that particular item, then you will get your GST turnover. So all those things which constitutes turnover under the GST but which does not constitute turnover under the financial statements are to be added. Similarly, all those things which constitutes turnover, which does not constitute turnover under the GST but which constitutes turnover under the financial statements are to be reduced. Only when you do this reconcile, what you will get is the turnover as per the GST. So entire purpose is we have to arrive at a turnover under the GST. So something which forms the part of a turnover under the GST but not under the general law or general financial statement, you have to add, and something which does not form the part of the turnover under the GST, that you need to reduce. So that is the basic arithmetics with which this particular part, para 5 or table 5 basically proceeds with. So unbilled revenue at the beginning of the financial year are those revenues in respect of which the income is already booked but in respect of which the invoices are raised subsequently. When the invoices are raised subsequently, that means on those items, there is going to be a tax implication, there is going to be a GST implication. Those are going to be the invoices issued under the GST regime. So those items you need to add back, and accordingly you have to arrive at a GST turnover. So income accounted for in financial year 16-17, but in respect of which the invoices are issued in 17-18, those are the items which basically would come under part 5B. Now the question comes, when you are saying that the invoices which are issued subsequently, that is in invoices which are issued in 17-18 should form part of over here, then what about April to June? Because April to June was a period which was not something which was a GST period, it was a pre-GST period. So there may be a possibility that you may have issued certain invoices in April to June. How are you going to, because if you report it over here, then to that extent your GST turnover is again showing higher amount. Then your GST turnover is showing higher amount, because that's not really a part of the GST. So at one place you say that I will not include April to June turnover here at all. That's one way to interpret it. What is the real interpretation? People will say, when you are saying that at the beginning of the financial year, you don't take 1st April, you take it as 1st July. You take it as 1st July. So that means automatically April to June will not come into picture. But if you really ask me, that's not what this particular form is actually telling you to do. As I have told you, financial year means 1st of April. So what it asks you to do is that you take audited statement of 31st March 2018 as a base. Because nobody is going to give you an audited statement as on 30th of June 2017. Everybody is going to give you an audited statement as on 31st March 2017. From that audited statement, those incomes in respect of which the invoices are issued subsequently, that you need to find out. So all those invoices would be basically added over here, and then subsequently if you look at point number G, April to June 2017, there it is showing you reduce the amounts. So whatever you are going to add over there in the first half, the same amount you are going to reduce in April to June 2017, and that is how the GST turnover, you will again arrive at a GST turnover. So whatever is the pre-GST turnover that you are reducing from here, whatever is the turnover for which invoices were issued after April, that you are going to add above. So that's something on which there was a service tax. Although you have added in the first, that is part B, you are going to reduce it as if they are the invoices issued in the subsequent year or April to June, on that you are supposed to reduce it. So that is the interpretation of unbilled revenue at the beginning of the financial year. Just to recap, it is something which was accounted for as an income in 16-17, in respect of which the bills were not issued in 17-18. All those items would come under part 5B. Now let us take a case, unadjusted advances at the end of the financial year. So we all know that under the GST, there are the tax consequences also on the advances. So under the point of taxation rules, or under the POT provisions, the advances in certain specific scenarios require that particular entity to make the payment of taxes, even if the bill is not issued. So all those advances in respect of which the bill is yet to be issued, but as per the place of point of taxation provisions, the liability forms part of your turnover for that particular financial year. Those you are supposed to add over here. So again, as I have told you, these advances are not the part of a general purpose financial statement. So they are probably in your liabilities under the general purpose financial statements. But if you look at the GST turnover, GST law specifically says that all these turnover advances you would be required to pay GST. So for 17-18 GST turnover, whatever advance you have received in 17-18, in respect of which the bill is not issued in 17-18, that will also form the part of a turnover. And therefore all these unadjusted advances, that means advance received in 17-18, but in respect of which bill is not issued in 17-18, but which is issued subsequently, would also be required to be added, and it would form the part of the GST turnover for 17-18. Then let us go to 5D, deemed supply under Schedule 1. This is going to be a challenging situation because deemed supply under Schedule 1 are those items. There are 4 items which are covered under the Schedule 1. All the items are the items which are where the monetary consideration or the consideration itself is not involved. Consideration itself is not involved, but still those items are treated as deemed as supply under the Act. To tell you a very simple example, your stock transfers between distinct entities. They are considered as supply within the purview of the GST law. So therefore, you already have included those items by assigning them a specific value under your GST books of accounts. They are forming part of your GST books of accounts, but they are not forming part of your annual purpose financial statement, and therefore for that particular purpose all those additional deemed supply transactions you have to add back over here. So you are one step closer to your turnover under the GST. So this is the item under the deemed supply that you are supposed to add back. So I don't think there is any difficulties understanding what do you mean by deemed supply under Schedule 1. Now comes the question of 5E, and let me tell you, this is the most debatable item in this entire sheet. 5E, credit notes issued after the end of the financial year. I will stop here. It says credit notes issued after the end of the financial year. I will stop here for the moment. I will not read the further lines but reflected in the annual return. Why I will not read? Because if I read but reflected in the annual return, then obviously you will have to go back to the annual return and you will have to see what you have disclosed there, because whatever is disclosed over there, it will come over here. So you don't have to apply your mind. Whatever you have disclosed over there, that will come over here. Now if you want to not apply your mind for the purpose of GSTR 9C, you should definitely apply your mind for the purpose of GSTR 9, because there by applying your mind only you would be able to come, or you will be able to put that particular data over there. But if you look at the instruction which is given in that particular item for GSTR in GSTR 9, which is annual return, which is yet to be covered, so Jignesh would be covering it in the next session. If you come at that particular instruction, the description is different and the instruction is different. Although it is technically a part of Jignesh, still I would like you to take through that particular item, because I am sure whatever I am telling, Jignesh is going to say the exact opposite thing. Okay, so I want to give you one more view for that. But for the moment, let us not read this but reflected in the annual return phrase. Let us understand with the logic of this particular form what it should be covered. So credit notes issued after the end of the financial year. Under the GST law, you can issue credit note anytime. It's not necessary that the credit note needs to be issued only in respect of that bill which is falling or which is issued in the same financial year. You can also issue the credit note in respect of an item which is pertaining to the previous financial year. So if a bill is booked in 17-18, you can issue the credit notice in 18-19. There is nothing wrong. What the law only says is that the credit notes cannot be considered for the purpose of deciding your tax liability if that credit note is not declared in the return later than September of the next financial year. That's what it says. So any transaction pertaining to 17-18, if the credit note is issued prior to September 2018, its effect will be considered on the tax liability. If that credit note is not declared in 17-18, that is up to before September 18, its particular effect will not be considered. And we have got our GSTN portal, which is so intelligent that after September 2018, it will not allow you to enter any credit note into the system pertaining to an invoice which is pertaining to 17-18. That is going to happen. So let me tell you how practically it is going to happen. So practically, probably for all 17-18 invoices, because we know when it is credit note, we have to give a reference to the original invoice number. If the original invoice number is going to be that of 17-18, then in the month of October, if you try to put any credit note where the original reference is 17-18, probably GSTN will throw an error. So basically, the law says that up till September 2018, you can make the adjustment pertaining to the invoices which were issued in the previous year. That is what it says. So if you ask me, as a chartered accountant certifying the accounts, I know what the credit note effect is all about. So what does credit note does? What does credit note does? So we are talking about here credit note issued as a supplier, because under the GST there is no concept of credit note, debit note being issued by the purchaser. There is always a concept of credit note, debit note being issued by the supplier. So what is the effect of this credit note? Credit note basically reduces your income. Credit note basically reduces your debtors. That's the effect of credit notes, correct? This is what the credit note is all about. Yeah. My suggestion is that let me complete my entire discourse. Then you are lucky. So let us not go into that. It may come, it may not be, but if you ask me, really speaking, it does not make any difference. It does not make any difference. So when it comes to a credit note, what it tries to do, it tries to reduce your liability, because as a result of credit note, whatever tax you have paid extra, that tax you are going to adjust. So suppose you raise a bill, original bill for 100 plus 18 rupees tax. So 118, so 18 rupees tax you paid to the government. Subsequently, due to various reasons listed in section 34, either due to deficiency of service or due to wrong charging or whatever, renegotiation of the contract, or due to post-supply discounts, whatever you call it as, if that particular price of 100 plus 18 is going to be reduced at 10 plus 1.18, so that 10 rupees, suppose that particular price is renegotiated, then to the extent of that 1.8, the customer is not going to pay you. So 10 plus 1.8, 11.8 rupees is not going to pay you. So to that extent, the credit note will have a credit to his debit balance, and to that extent, that particular balance is reduced. What you will do, to that extent, by 10 rupees you will reduce your income, and by 1.8 rupees you will reduce your liability, which is a liability for which you have already paid. So what you are going to do, what we are actually doing when it comes to tax ledger, whatever 18 rupees you have paid earlier, you are going to give a debit to that particular tax ledger by 1.8, and you are going to self-adjust that particular amount by issuing a credit note. But under the GST law, credit note is basically a turnover of that year in which it is issued. Although it is pertaining to financial year 17-18, credit note is basically a part of a GST turnover of that year in which it is issued. So what happens when you are finalizing your accounts? The accounting principles might require you that because this income is subsequently reduced before we signing the balance sheet, you take a effect of that particular credit note in financial year 17-18 only. So in your GST books of accounts, the turnover is still showing 100. But in your financial statements, the turnover is showing 90. So turnover is reduced to that extent. So what this particular adjustment tries to tell you is that because it is shown as 90 in your financial statements, you need to add that 10 rupees credit note in your general purpose, in your this reconciliation statement, so as to arrive at a GST turnover. Clear? Clear? Very clear. There is no ambiguity on this part. When we are talking about the purpose, what it tries to tell you is that whatever is the item which is going to be the turnover of the next financial year, for which the accounting law requires you to make the adjustment today, to that extent you increase your turnover and you add it back. If you look at that, this particular provisions become simple. Now, let us try and come to GSTR 9. Okay. I will not tell you as to how that particular GSTR 9 actually flow, because then it will basically take me to GSTR 9 and I will have to explain you all the GSTR 9 again. But let me open that GSTR 9 for the benefit of all, and let me show you what this particular credit note, where it was supposed to be reflected. Okay. So this part 5. Okay, this part 5 is something where you have seen 10 and 11, these two clauses. It says supply tax declared through amendments. This is a plus item, that means whatever is the finding above, you have to add it over here. And supplies and tax reduced through amendments, this is a net less item, so that is the net of credit. I will only tell you what is the interpretation. So I would rather suggest let us read it and interpret it together. So when it is talking that credit notes which are declared in the annual return, they are basically trying to point out at point number part 511. They are trying to tell you that. Why that? Why not any other credit note? Because earlier also under the same form in GSTR 9, there are references of the credit note. But why I am telling you that you refer to this only is because that is basically doing some adjustment in respect of a credit note which is issued in the subsequent year. That's the reason we are going to make this adjustment, because if it has been issued in the same year, then obviously there should not be any difference. There is a difference because there is a timing difference between the recording of that credit note and issuing that particular credit note and taking its effect into the books of accounts. So what does part 5 description says? It reads, particulars of transactions of the previous financial year declared in the return of April to September of the current financial year up to the date of filing of annual return of previous financial year, whichever is earlier. Clear? So let us first identify, what do you mean by previous financial year? 17-18. What do you mean by current financial year? So when I am taking a view that current financial year is 18-19, which annual return you are talking about? 17-18 or 18-19? This instruction is telling you about that year in respect of which you are going to file the return. So if you are going to file the return for 17-18, then according to me 17-18 should be the current year. 16-17 should be the previous year. Okay. If you are going to file this particular annual return for 16-17 or 17-18, then 17-18 is the current year, 16-17 should be the previous year. If you are going to file this return for 18-19, then 18-19 is the current year, 17-18 is the financial year. That's at least I am under my interpretation of this particular area. So what basically according to me this instructions gives a feeling is that what you record here is only a prior period adjustments. Prior period adjustment. Something which is coming into 18-19 but which were pertaining to 17-18, that you report here, not in the annual return of 17-18 but in the annual return of 18-19. That is, if you really literally read this particular wordings as particulars of the transactions of the previous financial year, that is 16-17, in the returns of April to September of the current financial year, that is 17-18, up to the date of filing of annual return of the previous financial year. 16-17 there was no return. So technically speaking, a view can be taken that for this particular table, for first year there should be nothing. Now let us go further for 18-19. Particulars of the transaction. So now you are filing the return of 18-19, let us assume. So particulars of transactions of the previous financial year, that is 17-18, declared in the returns of April to September of the current financial year, that is 18-19, up to the date of filing of annual return of the previous financial year, that is 17-18. So if you really ask me what this instruction or what this descriptions gives a feeling, because of this wording current year and previous financial year, is that current year is generally understood as the year for which you are working, and previous financial year is the year for which you are not working. So what year I am working for today is 17-18. So that's the annual return I am working for. So therefore nothing should come over here. Now let us go to instruction. Instruction under part 5. So this is instruction under part 5. Part 5 consists of particular of the transactions of the previous financial year but declared in the return of April to September of the current financial year or the date of filing of annual return for the previous financial year. So same description is repeated over here. Now for example, in the annual return for 17-18, the transactions declared in April to September for 17-18 shall be declared. So this is exactly reverse. So what this is saying over here is that you make a future period adjustment and not a prior period adjustment. What is an exact view? For that you need to study the entire sheet. For that you need to study the entire annual return, which Jagnesh would be basically going through. If you look at the entire sheet, what you would probably come across is that if any credit note was issued in your GST books of accounts in 17-18, now there is further hair splitting. If any GST credit note was issued in your GST books of accounts in 17-18, but which is declared in 18-19 in your GST returns, there can be a possible mismatch of GSTR 9 or your GSTR 1 and GST books of accounts. Something which is there in your GST books of accounts, you have forgot to include in your GST return, you included it in the subsequent year. That is possible. So what it tries to say is that something which is issued in the previous financial year, that is something which is issued in 17-18, if it is declared in 18-19, if it is declared into the returns of 18-19, then only you include it over here. So that's the further hair splitting. That's why I'm saying whenever you read the law, probably when we understand the purpose behind it, we were in a better position to give an explanation to it. We have got a similar kind of an explanation today under the TDS provision. And the view which is taken by many people is that the TDS is not applicable to interstate transactions because of that explanation. Okay, but if we understand the purpose of how this particular transaction is going to work in a real life, what is the purpose behind it, probably we would come out with a better interpretation. So here, the view which has been taken in the technical guide also is that something which was issued in the earlier year, but which was erroneously not reported in earlier year, but it was reported in the subsequent year, only those transactions would come over here. Now what is the implication of that? The implication of that is that there was an error on your part not to report it earlier. It was a turnover of the previous financial year only. It was a turnover of the previous financial year only because credit note was issued in the previous financial year. So it was a turnover of the previous financial year only. When it was a turnover of the previous financial year, but you did not include it in the return of the previous financial year, probably you may be required to pay an additional tax liability along with interest, and that particular thing the government wants to disclose in the annual return. That's probably the annual return's purpose, that the transactions pertaining to the previous financial year but declared in the current year, that means in 18-19. That is what they are trying to say. Now if you look at from this interpretation perspective, I am coming back to GSTR 9. Okay, so I told you one interpretation earlier. Now let us come back to another interpretation. The interpretation is that there was no timing difference. This was a turnover pertaining to previous financial year, but which was declared in the subsequent financial year. When it was declared in the subsequent financial year, that means you have already included that particular amount into the GST turnover. You have already included that particular amount into the GST turnover. When you have included that particular amount into GST turnover, that means that particular GST turnover is already reduced to the extent of that particular amount. Already reduced to the extent of that particular amount. If it is already reduced to the extent of that particular amount, that means there is no need for you to make any adjustment here, because it is already reduced. In your financial statement also it is reduced, and in that particular turnover is also it is reduced, because the effect of that is already taken as a negative factor in my GST returns. Because for credit notes there won't be any interest. Credit note reduces your tax liability. You have declared it before September, so to that extent that particular item is considered in your return. The reduction in the tax liability is given into the GSTR return. So your GST turnover is already reduced in your GSTR 9. GST books also it is less, and your financial statement also it is less. If everything is less, then there is no need for you to make an adjustment over here. Correct? There is no need for you to make any adjustment over here. There, in order to make this form workable, you have to presume that this adjustment would be required if in the financial statement that particular item is not considered. If in the financial statement that particular item is not considered. So that particular item is not considered in the financial statement. Therefore, to that particular extent my financial income is turnover is showing more, then I need to make any adjustment over here. Now if I have to make any adjustment over here, then it cannot be plus, it has to be minus. Because my financial turnover is showing more, my GST turnover is showing less, then that particular amount should be reduced. But here the sign is plus. Here the sign is plus. Therefore, all of you, when you go through the technical guide has made a presumption that in such a case, the negative figure will come over here. Because the negative figure will come over here, although the sign here showed plus, it will be reduced, and to that extent your reconciliation statement will come through. That is how that particular interpretation has been made in the technical guide. Why I am trying to throw light on this is because it was a very difficult position for the authors of the technical guide to interpret it in the absence of any clarification from the government as to how it should be represented. It was very easy for us to represent to authorities saying that this plus should be considered as a minus based on what our interpretation is. But then when no clarification comes and institute comes out with a technical guide on this particular aspect, these facts are really, institute speaks, authors are really trying to make it a workable proposition, and therefore some changes might come in the technical guide after the clarification comes. Therefore don't take the technical guide as it is. It's an utmost attempt to make this form workable, but if you really ask me, there is an error in this particular format. There is an error in this particular format. Means it should not be those words but reflected in the annual return should not have been there. If they are removed, then probably your form will work properly. I hope I am clear in explaining this particular aspect. Probably when GSTR 9 would be cleared, at that point of time you will get a better clarity of this. Yeah.
In this column 5E, whether we have to show provision for sales return, because normally statutory auditors are making provision for sales return, and that is also percentage.
Madam, let me tell you, there is a first issue under the GST law. We will not go into the technical issues under the GST law, but there is a first issue under the GST law, whether issuing the credit notes is proper in case of a sales return. Because let me tell you, there is a lot of controversy going over here. Especially somebody said about the pharma industry. Some clarification has now recently come up. Okay, so let me tell you, section 34 permits you to issue a credit note in case of a sales return. But then there is a practical difficulty that if at times that sales return happens after the September, then the credit note benefit cannot be given to the person who was a supplier. So in that case, if you really want to give effect of the law to the industry, then what he should be sending is not a credit note. He should not be returning that particular goods on the basis of credit notes issued by the supplier, but it should be a separate invoice under the GST. See what we are doing, I have always tried to explain this to my clients also. Please understand, the GST law is different from your commercial accounting documents. Whatever documents are prescribed under the GST law are the GST documents. Whatever documents are prescribed under the commercial law or the whatever issue are issuing to your clients, they are accounting documents. That's the reason when there is an export, your commercial invoice is in dollar, but your GST invoice is still in rupee, INR. Okay. There is also another example. You see any SAP, it will not allow you to enter the credit note unless and until the goods are received into the factory, because there is a technical control lapse. Unless and until the goods are received in the factory, the liability or the debt, the amount that the other party is supposed to pay me, the system will not allow them to reduce it. Because they want to make sure that the first let the material come, then only I will allow you to pass a credit note. Now if you go on that credit note, then the question comes how you are going to get back those goods at. Because other party is not going to issue any credit invoice to you. There is a movement of goods from one state to another, e-way bill is required, you have to issue a document. So if you are saying unless until the goods are received, I will not issue a credit note, is it going to work? Answer is no. So therefore,
Actually,
your question whether the returned provisional goods sales return should be shown over here,
yeah.
let us try to answer that question logically rather than going through the credit note debit note concept, because this is just a format which allows you to make an adjustment. It is not necessarily that those adjustments needs to be shown in plus in E only. You can make it in other adjustments also. So now, after having known this particular logic, let us try to see what is going to be an impact. The impact is that there is a sale or the supply which has happened in one financial year, for which the turnover is already recorded, income is already recognized in your books. At the same time, turnover is already recognized in your GST books. So when the first sale happens, both income as well as the financial statement as well as GST books both are at par with each other. Now when the second return is going to happen, the GST books of accounts, okay, the GST books of accounts will record that particular return in the subsequent financial year. But your financial statements are going to record that particular return in the same financial year because the auditor are insisting. So there is a time gap. When there is a time gap, you know that to the extent your income is shown less, you have to add it. There is no compulsion that you have to add this particular item in E. You can add it in other adjustments also. So the logic is that, do you have to add it? Answer is yes, you have to add it. But where, for that, please note, you don't have to strictly follow it should be added here or not. Ultimate purpose is that the entire reconciliation you have arrived at a proper figure correctly, and that is what I would mean by true and correct view. So let us go further. Trade discounts accounted for in the audited annual financial statements but are not permissible under the GST law. So trade discounts, again consider the impact. Trade discounts are accounted for in the audited financial statements. That means my audited financial statements are showing less turnover. But these credit notes are generally the post-supply credit notes. And when the post-supply credit notes are issued for GST purposes, those credit notes are going to be the turnover of the next financial year. And therefore, when they are going to be the turnover of the next financial year, for this particular purpose, I would be required to add it. That is how it is going to be. So therefore, trade discounts accounted for in the audited financial statements but are not permissible under the GST. So let me tell you, this is a case where in fact it is saying that these credit notes are not permissible at all. We all know that under section 15, valuation principles, the reduction in the value is permissible subject to certain conditions, especially in respect of discounts. Okay, so when you are giving a normal discount, if it is recorded in the invoice, there is no problem. But if it is not recorded in the invoice, but it is given subsequently by way of issuing of a credit note, in that particular case, there may be a problem. So technically again, the question will come, why this particular F is required if E is already there? Because for those trade discounts, again I am issuing a credit note. For credit note, something is already covered. Why it is separately shown? So let us not make these particulars as a watertight compartments. It is easier, it is permissible for us to play in whichever way it suits us. So let us now go F. So it basically says that under the GST, even if you have issued the trade discounts, because it is not fulfilling the criteria which is laid down in section 15, it is not permissible for you to obtain a reduction from your GST turnover. And therefore your GST turnover is 100. Although your financial turnover is 100 minus 10, 90. So because that particular reduction was not permissible to you under the GST, you add it back. That's the simple proposition. So that is how this particular add plus sign is come over here. Now GST turnover for April 2017 to June 2017. I think I have very much cleared this particular aspect, that whatever bills you are going to issue between April to June 2017, on which there is no going to be GST, those items you are supposed to consider over here. Because ultimate answer that we have to come at is the GST turnover. So something which is not going to be covered in GST, but which was issued during April to June, those items would be required to be covered over here. Therefore the sign is minus, and therefore that particular amount would be reduced. Your GST accounting turnover would be reduced to arrive at that particular GST turnover. Then unbilled revenue at the end of the financial year. This item is also reduced. Why it is reduced? Because these are the revenues which are accounted for in your financial year 17-18, but which are not billed in 17-18, they are billed in subsequent year. When they are billed in subsequent year, as per the GST law, that becomes the turnover of the subsequent year. That becomes the turnover of the subsequent year. But here you have shown in your financial statements this particular amount as a turnover of 17-18 only. So therefore you have to reduce that particular amount from 17-18 and you have to add that particular amount in 18-19. Therefore to that extent this particular, so whatever is my unbilled revenue at the end of the financial year, that becomes for 18-19 the adjustment under 5B. That becomes the adjustment under 5B for 18-19 because there it is going to be added. So that's basically the exact replica of 5B. Unadjusted advances at the beginning of the financial year. Unadjusted advances at the beginning of the financial year are to be reduced. So something similar to unadjusted advances at the end of the financial year. End of the financial year, when I am saying that I need to add it, that means I am trying to increase my GST turnover, means something on which GST has been paid. Unadjusted advances at the beginning of the financial year, when I am trying to reduce it, that means on that particular amount there is not going to be any GST. That means under the previous law, I have already paid some taxes on it, under the point of taxation prevalent under the previous law. So therefore now, under the GST law, I am not required to add it again. I will be required to reduce it, and therefore to that extent my GST turnover. So although my bills will be issued in the GST regime, on those bills I am not charging any GST. Why? Because suppose take a case that there is a service going on. The service rendering actually happens in 18-19, maybe after July 2018. So the invoice is issued after July 2018. But for that particular service, entire amount is considered as an advance in the March 2017. The service tax law under the earlier law required you to make the payment of tax on advance basis. So you have already paid the tax, collected that service tax and paid it to the government on advance. So therefore, now when you will be issuing the bills into the GST regime, you will not be charging any GST on that particular amount. The GST will be nil, although it would form the part of the turnover, and therefore to that extent, this adjustments needs to be done. That particular amount which is included in the turnover, because the bill were raised in the subsequent year, but on which the tax is already paid under the pre-GST regime, that amount needs to be deducted from here. Then credit notes accounted for in the audited financial statements, but not permissible under the GST. So credit notes accounted for in the audited annual financial statements, but not permissible under the GST. What would it mean? It means that under the accounting year, the credit notes have been reported. So that means your accounting turnover is less. When they are not permissible under the GST, that means your GST turnover should be more. Correct? Your GST turnover should be more. If your GST turnover should be more, there should be plus sign, not minus. It is same as your trade discount. Trade discount which is permissible under the earlier GST regime, but not allowed. Similarly, credit notes which are issued, accounted for, but not allowed into the GST regime. So therefore here also, if you look at, the sign should be plus. But if we consider that the credit notes would be reported as a minus, then that minus and minus becomes plus. And therefore this particular transaction becomes easy. So therefore, here either you can say that there is a mistake, or you can say that the credit notes are going to be reported, this figure will come as a minus and that minus minus becomes plus. So therefore to that extent again the reconciliation will be required to be seen when the actual electronic formats will come. Then adjustment on account of supply of goods by SEZ units to DTA units. This means that the auditee is an SEZ unit. It is supplying the goods to a DTA units. When it is supplied the goods to the DTA units are basically the one who are clearing it by filing a bill of entry, and accordingly the payment of tax is generally done by the DTA units. So it is that turnover which in simple terms in your hands does not attract any tax. The tax liability is not on you but on the person who is clearing the goods, and therefore although it is considered as your financial income, for the purpose of GST turnover that particular amount needs to be reduced. That is what the meaning of this particular clause. Then let us come further, let us go further. Turnover of the period under the composition scheme. So whatever is the composition scheme turnover is there, obviously you have to reduce it because there is no impact so far as there is no certification so far as that composition scheme turnover is concerned. So you have to reduce that. Then adjustment in turnover under section 15 and rules thereunder. This is basically some pricing adjustment. So because of certain valuation rules, valuation under the GST law may be something else. The accounting income under the income actual recognition may be something else, and therefore whatever is the adjustment that you have to make an adjustment. So these adjustment can be plus or minus anything depending upon what you are doing. So if you really ask me, there is a possibility, there is a something called as a specific taxes. So under the foreign exchange dealers, they have got a specific way in which they are supposed to make the tax. Or if somebody is on cash basis of accounting, he is required to pay tax on accrual basis of accounting, then there is going to be a mismatch. That mismatch is nothing but the mismatch in the value. So all those adjustments can be basically covered part of in M. Then adjustments in turnover due to foreign exchange fluctuation. So probably at the time when you account for a particular invoice, at that point of time there may be separate rate, different rate. The rate at which you are issuing it for the purpose of GST, there will be different rate. The rate at which the foreign exchange is realized, there is a separate rate. And then there is a difference which you are recognizing as a foreign exchange loss or gain. So that particular item is basically forming part of your turnover under the Income Tax Act, under the General Purpose Financial Statement. Therefore, to that extent, you have to make an adjustment. So these adjustments are required to be made over here. And then we have got 5O. So let me tell you, this is the most beautiful thing. Whatever adjustments you believe, you are not sure that whether this is possible to report it over here or not, or wherever you feel that there is plus minus issue, you adjust it over here. But my only request is that whatever you are adjusting, prepare a detailed statement of it, so that in future, whenever your inquiry will happen, because GST audit is now a very risky field, so whenever your inquiry will happen as to how you have arrived at this particular figure, you are having all your working papers ready with you. So this is so far as part A. Now you come at P, annual turnover after making an adjustment above. So this is basically a arithmetic calculation. You will get a calculation at 5P. 5Q is the turnover as declared in the annual return. This is what I was telling you. Is after now this is the first part is the difference between your financial statement and the books of accounts. So financial statements and the books of accounts, you have made some adjustments. So now you have arrived at a figure which is as per your books of accounts. Then what it tries to give, Q is and turnover declared in the annual return. So they are first trying to bridge the gap between items which are flowing in your annual return and items which are there in your GST books of accounts. If there is any difference, and if that particular difference is positive, that means if as per books of accounts something is more, if as per annual return something is less, then on that particular differential amount there could be an additional tax implication, which is an unreconciled turnover under Q minus 5. That is how this is going to be, and you have to give a reason for it. Now let me also tell you, there could be a possibility that the client may say that you have to take it by way of a deduction. Because according to me, that is nothing to do. This is not a turnover pertaining to this particular year. This is a turnover pertaining to the next year. You may say, no. According to me, this is a turnover pertaining to this year only, so you cannot take the reduction. So there is a dispute. There is a dispute between you and your client. Now the question comes, should I report those particular items here? Should I consider it as a unreconciled item? Or I should take some other position? So if you ask me, really speaking, you cannot substitute your judgment for the judgment which is taken by the auditee. So in this scenario, whenever there is a disputed item, I would suggest that you do not take it as a part of an unreconciled turnover, because on that particular item the SSE has got an explanation. But if you have a differential view from what view the SSE has taken, then instead of reporting it and asking him to make the payment of tax at 81 level itself, you report it in your audit report, which is part B certification. So therefore, the view or the general principle at least that I would try to explain over here is that if after doing this exercise, if there is some difference and on that difference the SSE has
got no different view and both of you are at the same page that the liability is payable, you report it here as an unreconciled difference on which the liability is payable. But if there is a difference of view between you and your auditee, then in that particular case, you do not report it over here. You consider it as a part of your reduction, but since you believe that that particular item needs to be pointed out separately, your view needs to be pointed out separately, you take care of that in your audit report, because in the audit report there is a specific place for it. So that is how that particular thing can go further. So whatever are the reasons for unreconciled differences, those items you are supposed to give over here. Now here again, those items over which the you and your SSE both are at the same par, at the same page. So you know that there was an error, tax was liable, it was not paid, so that particular amount will come over here. Now let us go further. 7 is basically reconciliation of taxable turnover. So when you are talking about reconciliation of taxable turnover, now you see this table is basically trying to tell you is that whatever is the annual turnover as per books of accounts, which is reported in 5B, that entire thing will come over here. And now you try to make a difference out of this, what is taxable, what is exempt, that you identify. You remove the exempt turnover. You remove the exempt turnover, and after removing the exempt turnover, whatever taxable turnover remains, on that taxable turnover, you see what is the taxable turnover reported in annual return, and to that extent you further make a comparison. So first difference or the first comparison was between your aggregate turnover as per annual return and aggregate turnover as per books of accounts, where there was no, because aggregate turnover includes everything, your exempt supplies also. The second is the reconciliation of the taxable turnover. So out of the turnover that you have declared, if there is any difference between the taxable turnover as per books of accounts which you have audited and the taxable turnover as per annual return which the SSE has filed, if there is a difference, that difference you are supposed to give here. Again, as I have told you, if there is a disputed item, then to that extent you may be required to take a call. But then 99% that situation may not come here, because the turnover of liability declared in annual return, that is an auto-populated figure. So it will come directly from your GSTR 9. So whatever figure he has filed over there, that will come over here. Now there could be a possibility that in the annual return, the person has disclosed wrongly, but he realized that there is an error. He basically then paid the taxes, not through his annual return, but in subsequent GSTR 3B, which may have been filed after September. Today, according to me, there is no provision in GSTR 9 to take care of that particular item. So therefore, there can be a possibility that you are getting a difference. The client also agrees with that particular difference, but the client has already paid that particular amount through GSTR 3B. Unfortunately, today, under this reconciliation format or under the annual return format, that particular part has not been highlighted. And therefore, to that extent, probably you may be required to disclose it by way of a note in your notes to your GSTR 9 or notes to your GSTR 9C or notes to your audited certificate. Somewhere you have to give, because that's the reason we have also made a representation that for all this GSTR 9 and GSTR 9C, you also allow us to upload something by way of a note. Because if you allow us to upload something by way of a note, probably it will strengthen what is the basis that we have taken for arriving or making this particular certification possible. This is so far as reconciliation of the taxable turnover. So if you look at from that annual turnover as per GST books, the value of exempt turnover, zero rated turnover as per GST books are supposed to be reduced. What comes is the taxable turnover as per GST books. That taxable turnover as per GST books is to be compared with taxable turnover as per GSTR 9, and whatever is the difference on that, the auditor needs to take a position. So this is so far as the outward supply is concerned. Now let us look at the reconciliation of taxes paid. This reconciliation statement is also the reconciliation statement on the basis of which the tax has been payable. So if you look at, this is the reconciliation of rate-wise liability and amount of tax payable. They have not talked about paid. So if you ask me, this is also as per the books of accounts, what taxes are payable. So whatever is the difference of the 81 and 82, if there is any tax payable, the auditor is required to disclose it over here. It is a responsibility that that particular amount on which tax was payable but not paid is supposed to be disclosed over here. So this is basically after comparing with your books of accounts and GSTR 9A, if there is some difference on which there is undisputedly tax payable, that amount should also be added over here. And then this particular amount which is going to be added over here, this is going to be compared with the amount paid as declared in annual return GSTR 9. Now amount paid in annual return GSTR 9, if you look at, this is basically nothing but what amount you have paid through 3B table 6. It basically includes two types of thing. One is table 6, which is basically the returns 3B filed for July to March. It also tries to include the liability which you have additionally disclosed under 10 and 11, those controversial tables which we just discussed. So if there is any additional liability as a result of those disclosures, then that is also added and that particular amount will come over here. So therefore, basically what it tries to tell is that whatever as per your audit, whatever is the GST payable that you disclose, as per 3B, whatever is the GST paid, that will be captured over here. Whatever is the difference between the two, that is an additional PT1 that is required to be disclosed. And therefore I am saying that if you include that amount in 81, then automatically if there is any dispute over which there is no reconciliation between you and your auditee, and if you take a position, no, I will have to disclose it over here, then the auditee unnecessarily will end up paying taxes on something for which he has got a bona fide explanation. So therefore, on 81, only the admitted liability will come. Unadmitted liability will not come in 81, because if you include unadmitted liability into 81, then to that extent PT1 will be also computed on that amount, and therefore there may be problems subsequently. Then comes the reasons for reconciliation, then additional amount payable but not paid due to reasons furnished below. So if there is any difference between the thing and PT1 is there, then that particular PT1 which is unreconciled payment, that also you are supposed to make the payment, and as a result of 81 and 82, if there is any liability, that also you are supposed to make the payment. So if you really look at, by virtue of whatever I have tried to explain, the effect of 81 and 82 will automatically come in PT1. So PT1, out of which how much you have paid actually, how much you have not paid actually, that you are supposed to disclose in this particular 11. Out of PT1, according to you, PT1 was payable, but out of that how much you have not paid, that particular amount will come in 11. So here probably you have got a chance to say that if out of that PT1 nothing is disclosed over here, that means the person has already discharged the tax either by filing of the DRC 3 or by filing of his 3B in the next financial year. So basically if nothing is disclosed over here, that would mean that that particular amount has already been paid, because till the signing of your annual returns, till the signing of your audit report, if the payment is not made, only then those amounts will be shown over here. That's the view that I am taking. We may have to see what view has been taken in technical guide. Now comes the reconciliation of an input tax credit. So let me quickly tell you, because I think we have got 15 minutes left. So let me quickly tell you, this is again, first understand the concept. Under the concept, if you look at, this is again the reconciliation between your financial statement and books of accounts. So first you try to identify those differences. Once you identify those differences, then you compare your books of accounts with whatever you have claimed in return. And if there are any differences in that particular amount you have to report to. So for here also there are two reconciliations. One is the reconciliation between the books of accounts and the financial statements, and another is the reconciliation between the books of accounts and the ITC that you have declared in your return. So let us go first with 12A. Now here ITC availed as per audited annual financial statements. It is not making any bifurcation. CGST, SGST, IGST, the total consolidated amount of tax is required to be shown over here. Then ITC booked in earlier financial year, claimed in current financial year. So because it is not necessary that you may have booked something in your financial statement in the earlier financial year, but you may not have taken it at that point of time. You may have taken it in this particular financial year, so you take it accordingly. At the same time, there may be certain amounts which may be considered or are accounted for as an ITC credit in your tax ledger, but you may not have claimed it over here. You may have claimed it in the subsequent return, subsequent financial year. So to that extent, you have to reduce it. So this is basically B and C are nothing but prior period adjustment or future period adjustment. So it is very clear that you have to first, your starting point is your ITC as per the books of accounts. So your tax ledger would be your starting point. In that you make the prior period and future period adjustment. You will come across ITC availed as per audited financial statement or books of accounts. Now this particular amount is auto-populated, which is 12A plus B minus C. After you arrive at the item as per books of accounts, you make a comparison with ITC claimed in the annual return, that is GSTR 9C. So the first difference, that is ITC 1, is the difference between the books of accounts and general purpose financial statements. You give the reason for it, whatever are the reasons, on that ITC 1, the payment would be triggered. So here also, if you don't agree with something, don't put it over here. If both of you are on the same par, only then that particular amount will come over here, because this ITC 1 will trigger into the payment in the hands of the auditing. Then reconciliation of ITC declared in the annual return with the ITC availed on the expenses as per audited financial statement or books of accounts. So here if you look at, according to me, this is again a difference between annual return and the audited books of accounts. The challenge in preparing this particular statement, so it's very easy for us to criticize, so I will not spend much time in criticizing, but I am very sure you might have heard it and this is very impossible to do. I am quite conscious of this particular fact, but let us right now only concentrate what this particular table tells you, what are the issues involved. So first of all, it's basically giving you a bifurcation of, as per GST books of accounts, what is the value, what is the total ITC, and what is the amount of ITC availed. So we had represented that there is no need for you to make such a expense-wise bifurcation, because this is going to be beyond imagination. People have not prepared. In the purchase register, nobody has stated where this particular item is debited in the financial statements. So therefore, to that extent, this particular table is going to be very nightmare for auditee and also for auditor to check on that particular aspect. So that is one aspect which has been prescribed. Another thing is that since this is a reconciliation of the GST books of accounts with the 9C, it may also include your prior period and future period adjustment. So therefore, if you try to rely upon your GST books, in your GST books, unless and until it is properly mentioned, you are not in a position to take care of it. And let me tell you, what about ISD? Because in ISD, there is no expense, there is only credit. So there may be certain credits taken in your books because it is distributed by an ISD. Expense may be lying in the books of HO, the credits may be lying in the books of somewhere else, because ISD never distributes the expense, ISD only distributes the credit. If you look at ISD invoice, there is no value, there is only credit. So how to report the transaction in those cases? There is still no clarity over there. So therefore, to that extent, again the representation has been made to unnecessarily not to include the auditor or the auditee in such kind of an exercise. It is not going to serve any purpose. Anyway, especially when 2A is in force. So there is no question that anybody will claim any credits which is not belonging to him otherwise. So therefore, this particular part is a representation part, but coming back to the logic or concept, total amount of ITC as per books, the government wants an auditor to consider what according to him is eligible and what according to him is ineligible. So this is again based on your audit of the GST books of accounts. The auditor is supposed to give his recommendations here. This is basically when you are saying amount of eligible ITC availed. According to me, if you really want to make this exercise a fruitful exercise for the revenue, which obviously the revenue's expectation are, then you are not supposed to report here what is already the stand taken by the department or stand taken by the auditee. If as a part of your audit finding, if you feel that there is something which was required to be reversed, but which was considered as, was supposed to be considered as ineligible, but the auditee is considered as eligible, and if both of you are on the same page, then that amount of ineligible credit needs to be reported over here. Eligible credit only to the extent both agree should be reported over here, and therefore in that particular case, even if you have reported something else in the return, still there would be a difference between what you are reporting over here and what your position you have taken at the time of filing of the return. The difference between that will be your ITC2. So the first ITC1 is the difference between your books of accounts and the financial statements. Second ITC is the difference between your books of accounts and what you have claimed as a credit in your returns. The difference, addition of ITC1 plus ITC2 might result in additional tax obligation which are required to be reported in table 16. So that is where the additional tax obligation unreconciled difference due to ITC may be required to be reported. Then, as I have told you that so far as those items where there is a dispute between an auditee and auditor, some items you may agree in the first part. You may allow that particular SSC to take the deduction in the first part. Still, the law provides, the form provides that if you believe that that particular item needs to be added back, you can make the quantification of that, and that quantification can be inserted in part 5 by way of an auditor's representation. So it is very clear that this is auditor's recommendation. This auditor's recommendation is not resulting into any payment in the hands of the auditee. But there could be, what auditor is trying to say is that according to me, this is the additional obligation. He will also try to give a justification or the explanation of that particular quantification in his audit report. And if the revenue authorities are conscious enough, they will read this particular thing, and accordingly they will proceed with the assessing author with that particular SSC so far as their assessment is concerned. So we have come to the last part, verification. Again, some representation have gone, because this representation, this verification gives a feeling as if this particular statement is prepared by an auditor. If you look at the law, the auditor does not require an auditor to prepare a statement. The law only requires an auditor to certify the statement. The preparation of the statement is the responsibility of the auditee itself. And therefore, to that extent, some changes would be required. So it has been represented that instead of this verification given as a auditor, you only consider that particular verification as if it is given by the auditee. So you make that particular change accordingly. Coming back to your instructions, you may go through those instructions. There is nothing new from what I have already told you, except for some of the controversial things which I have already discussed. Quickly, last 5 minutes on the certification aspect. So as I have told you, part B, certification, it gives 2. So here also some recommendations have gone, that you don't use the terminology certification in cases where the reconciliation statement is drawn by the person who is audited. These statements are not drawn. They are drawn by the auditee. We have only certified it. So therefore, to that extent, the change of words have been suggested in this particular line. Then, as I have told you, this is the format where if a person carrying out a statutory audit under any other law and a person carrying out a GST audit is the same, then this particular format is applicable. If a person carrying out a GST audit is not a person who has carried out a statutory audit, then part 2 would be applicable. So let us glance through what is the difference between part 1 and part 2 very quickly. So part 1, this, although I am taking it last, is the most important certificate, because this directly affects the interest of the auditor who is going to certify that this particular statement or audit the books of accounts under the GST law. So we have examined balance sheet on the profit and loss account and expenditure, the cash flow. This is basically general purpose financial statement. So there is an examination of these general purpose financial statements. Then based on the audit, I will report that the said registered person has maintained the books of accounts, records or documents. This assertion, this assurance is qua the GST books of accounts. So while the first was only that in order to arrive at the reconciliation, I cannot arrive at a reconciliation unless and until I have examined the general purpose financial statement, because these are ultimately the comparison between the two. So I have seen those accounts. I have also seen the GST books of accounts. I have also examined the GST books of accounts. Based on the audit, I will report that he has maintained it or he has not maintained it. So basically what the first point I told you, that you please make sure that your auditee is having proper GST books of accounts in place. Because if he is not having the GST books of accounts in place, probably it may result into you reporting your observation or a disclaimer in this particular paragraph. So 1, 2, 3, your observations. I will report the following observation, comment, discrepancies if any. If you have got any disputed item where you and the auditee are not on the same page, this needs to be reported over here. I will further report that we have obtained the information and explanation to the best of my knowledge and belief which were necessary for the purpose of audit, and explanation which to the best of my knowledge and belief was necessary for the purpose of audit and have been provided to me in my opinion. Now if you look at this para 3, according to me is basically an additional assurance that my audit under the other law is also equally correct. Technically speaking, there was no need, but still, as this particular format is applicable to the same auditor who has carried out statutory audit also and GST audit also, the format has incorporated if you are giving an assurance there, you should not have any problem in giving an assurance here also. So technically speaking, it is a repetition of what assurance you have given under the other audit. Same things would come over here. So if there are any qualifications there, same qualifications will come over here. But if you really ask me, there may be certain categories where the audit may not be required. Audit under any statute may not be required. To them also, probably the law requires, if you are a GST auditor of such an entity where any audit under any other law is not required, still this form, this assertion makes it very clear that under the GST audit also you are supposed to audit his other books of accounts, financial statements, and accordingly make a representation. So therefore, clause 3B is very wide when it comes to auditor's obligation in reporting observation in respect of those clients who are not required to audit, carry out audit under any other law. The documents to be furnished under section 35(5) of the CGST Act and reconciliation statement are enclosed herewith. In my opinion, now this is the most important line, in my opinion and to the best of my information and according to the explanation given to me or us, the particulars given in the said form number GSTR 9C are true and correct. So what is true and correct are only the particulars which are given in GSTR 9C. It does not mean that you have to carry out 100% vouching. Your audit principles would still be applicable, and therefore the first words, in my opinion, to the best of my knowledge and information and accordingly explanation given to me. So these are the words which would probably protect the auditors, because nobody can substitute an auditor's opinion even if it is wrong. So therefore, as long as you have got the basis for forming an opinion, probably I would not consider that opinion as a problematic opinion having any repercussions on the auditor, even if subsequently it is found that the classification in which the auditee has done it as an auditor has accepted is wrong, as long as you have got a basis for your opinion. So therefore, just to conclude, the second certificate, as long as similar to what is part 1, we report that the audit of the books of accounts has been done by some other member. So it's only pointing out that I have only conducted the GST books of accounts audit. I have not conducted the financial statements books of accounts audit. That has been conducted by somebody else and that has been annexed over here. I will report that the registered person has maintained. So as a GST auditor, what is my obligation? Was there in the part 1, the same obligation continues in part 2 also. Rest of the things are almost same. There is absolutely no difference. Whatever was there in part 1 is there in part 2. So this is so far as part 2 is concerned. Last but not the least, let me tell you, audit is a complicated exercise. It's not something which you can do without knowing the fundamental provisions under the GST law. The reconciliation statements between GSTR 1, GST books of accounts, GST books of accounts, GSTR 3B, GST books of accounts, financial statements is something which is a must, without which you cannot come across a particular findings, without which you won't be able to express your opinion in a proper manner. But nonetheless, any person who wants to carry out an audit need to have two bare minimum requirements besides he being a chartered accountant. Number 1 is that he need to know all the forms, GSTR 3B, GSTR 1, GSTR 2 and GSTR 9. All the forms, and in fact GSTR 9C. Everything he needs to know very detailed manner. And secondly, the provisions of the GST law he needs to know in a significant detailed manner. At least to the extent there are controversy, he can support his view by whatever explanation he wants to give but whatever are the basic requirements regarding eligibility, ineligibility and all those things, auditor cannot absolve himself of those responsibility, and therefore this acquiring of the knowledge, attending the seminars, reading the books is indispensable for any person who is going to carry a GST audit. I thank you all for this opportunity. If there are any question, time permitting, we can take the same. Thank you.
Sir, I have one question. Do I have to do GST audit for input service distributor and non-resident taxable person? Because
See,
for annual return,
Let
they
me
are-
tell you. Let me tell you that GST audit, there are three provisions. One is 35.5, another is 44.1, and third is 44.4. 35.5 is basically requires you to carry out an audit. 44.1 is the annual return provision, which excludes certain person. I believe ISD is one of them, and non-resident is one of them.
Yes.
And then 44.4 comes, which says that ki you have to carry out, you have to furnish a reconciliation statement along with the GST audit. So if you really want to carry out a GST audit, unless and until there is a reconciliation statement, there cannot be a GST audit. And reconciliation statement cannot be required to be prepared unless and until there is a return. So therefore, all those entities where the requirement of filing of an annual return is not there, according to me, there is no need for you to carry out a GST audit.
Thank you.
See, as I have told you, the concept of turnover is again something which is not linked to a particular distinct entity. If you look at the turnover as is understood under the GST, it ignores whether you are having one registration number, two registration number. It basically takes your pan India turnover. As long as it exceeds the threshold limit, you would be required to carry out an audit. So first requirement, in order to see whether you are required to carry out an audit, you need to see whether your pan India turnover exceeds that limit or not.
Yes.
Once it exceeds, then the question comes as to while carrying out an audit, whether only one report is required to be prepared or separate reports are required to be prepared. So there the law is very clear. The first part, general information, GSTN is required to be mentioned. So as many GSTN you have, those many audit reports GSTR 9C would be required to be prepared. Very clear.
Okay, thank you.
Hello, sir. As a practicing chartered accountant, like we have been providing consultation throughout the time GST is been rolled out. Now I have to sign the GST audit report also. So will it not be a conflict of interest, because we have been providing all these consultations on mails, either on, we have been asking them how to do the accounting part of
If
it.
my memory stands corrected, the same issue was also there when you were acting as a tax auditor, when you were acting as a tax consultant. The institutes had clarified that there is no conflict of interest. If you are acting as a tax consultant or if you are acting as a tax retainer, as regards the GST audit is concerned. So I believe that the same position would apply in the GST also. In fact, except for the clarification regarding that internal auditor cannot undertake a GST audit, no such other clarification has come out. And if you refer to the technical guide, there also the similar view has been expressed. But again, ethics is something which is a very subjective. There cannot be a legal rule or something. There are only guidelines. So you have to take into, because there are certain principles that self-review, a threat of a self-review is one of the principles. So how far you are actually breaching that particular principle when you are looking, because advocacy, self-review, these are some of the principles. So your involvement, because you are not imposing anything on your client when you consult. You are only consulting. Whether to accept your view or not, that is up to him. Subsequently, your opinion is also subject to a change, because many a times the changes in the law might require you to change your opinion accordingly. So therefore, mere fact that you have taken one opinion does not mean that you have to take the same opinion if subsequently something else comes out. So therefore, I believe ethics is a completely different ballgame altogether, and each case needs to be seen individually. But if you ask me generally whether there is a prohibition, I would not say that there is any prohibition, because the at least the council guidelines and the technical review guide is taking the same view in that regard.
Sir,
Thank you.
Hello. Hello, sir. Sir, as we have gone through that 9C and 9 annual return, it is all certification of factual thing.
Yeah.
Nowhere it is been required by the auditor to whether it's the classification. Sometimes there is a difference between the classification between the auditor and auditor.
Correct.
Whether we should report on the
No,
audit.
so as I've told you that if you have gone into the details, because the role of auditor, the auditor should be an auditor. He should not be sitting into the shoes of the adjudicating authority or the Supreme Court or the High Court. So therefore, if you believe that because of some of the judgments which come across the dispute in the classification, and if the SSC himself has a history of that particular litigation, that means he has taken the similar view in the past. Same classification is continuing in the present. That means there is some consistency in the view which is taken by the author of that particular auditee, and probably the no dispute has come up. Over there, if you believe that the classification is patently wrong, resulting into any kind of additional tax obligation, then as I have told you, you can report it in your auditor's recommendation or in your certification, but nothing in the law requires you to give or compel the auditee to make a payment thereof. So that's the only role that you are supposed to pay.
Suppose anything left out on the legality point, whether the auditor be liable for that.
No, as I have told you, to the extent the law is clear, you need to exercise your reasonable judgment. So therefore, as long as now, for example, if there is a computation required to be made, and that computation does not have any legal issues, if that computation is incorrect, then obviously you will be held liable. But if, as I have told you, some of the reporting, some of the ingredient might require an interpretation issue, you have taken a position and you have got a specific working paper for thing. I don't think anybody can take a view that you are wrong on that particular case.
Sir.
So one question was, in RCM for 3 months, July, August, September, there was a condition for self-invoicing. So in GST audit, RCM पे कर दिया ठीक है, but वो self invoicing बनाया, उसका record वो सब भी check करना, और नहीं किया तो कहाँ report करना?
See, as I have told you, similar questions, that the auditor is not in possession of the invoice, but he has made the payment to the party and the amount is appearing in GSTR 2A. What should I do? Should I allow the credit? My answer would be yes, because if you really ask me, having possession of that particular invoice is one of the conditions in section 16. But possession of an invoice is with a view that the person is not claiming a false credit. So as long as you are in a position to demonstrate the purpose for which that particular provision is, I don't think you should take a very adamant view that I will not allow you. At the same time, there may be a possibility. I will come to your question little again after this. At the same time, there may be a possibility that somebody have got a physical invoice, has made the payment is within 6 months, but it is not being reported in 2A. In that particular case also, according to me, the credit needs to be given. You should not say that it is not appearing in 2A, so I will not give the credit, because at least so far matching concepts are not operational. Now coming back to your case, whether all the invoices needs to be prepared, as I have told you, we have to do the audit as per the auditing standards, as per auditing principles, and that's the reason we have been chosen for that particular aspect. So in your sample, if you ask me whether it is legally required, answer is yes, it is legally required. Are you going to check each and every item? Answer is no. You are going to do a test check, sample basis audit. If in the auditing sample, if you found something significant, or the auditee himself is saying that I have not prepared anything, then obviously you need to ask that particular person to prepare all those things. Because I am telling you, this is the first year, many people have not even prepared the purchase register, sales register. So practically, if you ask me, those who have not prepared a sales register, we are saying, okay, you have not prepared a sales register, no problem. Then treat the GSTR 1 as your sales register. We will treat GSTR 1 as your sales register, and if there is any difference between the two, you will be liable. Something like that. So we have to take a call accordingly, depending upon what is.
Sir, as you said, for expense part, the institute has made a representation. So if we are starting GST audit now,
You don't consider any representation as of now. You don't consider.
so we
It's
have
very
to
clear.
ask
If you are not
client-
able to do anything, you can give your disclaimers.
Okay.
Is merely the statute requires you to do something, does not mean you can do it. If you can't do it, you have to give a disclosure that you are not in a position to do it. Obviously, it does not look good on your part also and on part of auditee also. Then, if required, that is the way you are supposed to deal with it.
Okay.
Sir? Yeah, so there is a, sir, this reconciliation, the whole thing is annual. If there are differences in a monthly thing, is the auditor required to check it monthly? Means interest
No,
provisions
so
and all
as
of
I've
that?
told you, point of taxation is something which, as a part of general audit, you may be required to look into. But fortunately, there is no reporting. So as I've told you, same answer which I have given to this gentleman, same answer applies to you. If under the sampling techniques, if you come across these kinds of things, then probably, if you come across a situation, you may ask the person to rectify it. If you feel under the second batch of the samples, similar things are happening, then obviously you may be required to report it. But I would not say that if you fail to report it, there is anything wrong. I would not take that view. As long as your documentation is proper, you have applied to the auditing principles properly, I don't see that there is anything wrong in that particular aspect. That is my view, strictly my view. It may not be the view of the institute, it may not be view of others. That is strictly my view.